we will go through a few slides, which I think are quite relevant to put in perspective the positioning of the portfolio and how I'm thinking about the portfolio from a more medium-term perspective. So this is a chart which is actually quite telling. It's a very simple chart. It encapsulates really what we mean when we say long-term. We've broken down the last 40 years into 10-year periods. And you will see that each decade has some momentous, once-in-a-lifetime kind of event. And we put this because, there are a lot of questions now around Russia-Ukraine war. We've never before seen this kind of geopolitical crisis. There is talk about quantitative tightening. There is talk about various ones, what seem to be momentous events. But if you look at the last 4 decades, every decade probably has seen some or the other event of huge impact to either the Indian economy or the world economy. But you will see that the real GDP of the country has actually, over a longer term time frame, stayed steady in that 6-7% kind of ballpark. So whether it's the 90s, where there was the Gulf War, there was the Asian crisis, whether it was the 2000s, where we had the dot-com bubble, whether it was the last decade, where there were a lot of India-specific disruptions as well, you will see that the one thing that has stayed constant has been the 6 to 7% kind of real GDP growth that the country has reported. And I think this is on account of fairly organic structural growth drivers that the country has. This is really a testimony to the resilience of the economy, as well as the fact that there is an inherent growth dynamic which helps overcome, over a period of time, several disruptions, either globally or domestically. So what are, in the medium term, what are these factors that we think will help India continue to stay on its growth path? And I think the next few years broadly revolve around manufacturing, India's increased manufacturing intensity, the shift from the unorganized to the organized segment, something which has been in progress, will continue to be so. An improvement in the investment intensity of the economy, whether it is housing, whether it's private sector Capex, whether it's the government infrastructure, as well as catalysts to manufacturing coming in from the China Plus One, as well as government policy initiatives. Of course, one must also be mindful of the risks. The risks, as we all are aware, are and which are well flagged, are geopolitical, rising rates, as well as elevated commodity prices. We will delve into each of these in a little bit of detail, but this is just a snapshot of the kind of opportunities that the economy faces at this point in time, as well as a snapshot of the risks. So let's just start with a pickup in just private sector Capex, as well as housing and government infrastructure. Now, investment activity in general is capital intensive, and therefore the banking system needs to be in good health in order to support the kind of investment activity. We've seen that over the last few years, the banking sector has gone through a significant phase of restructuring and repair. As you can see, the NPAs, the net NPAs of the banking system peaked somewhere in 18, and we are now on a downward trajectory. Capital adequacy, which is basically the raw material basis which banks lend, is also in pretty healthy shape. Capital adequacy is near a 2-decade high. The credit demand, of course, has been weak, and but in our opinion, credit demand has bottomed out. We are already seeing a pickup in credit demand. The latest month number indicates a move to double-digit kind of growth. So the fundamentals for funding of infrastructure or capital investments required by the corporate sector, the banking system which will provide that is in pretty good shape, and therefore, from a funding perspective at least, it appears that things are pretty much in order. Let me switch to first, what is the opportunity for private sector Capex? The opportunity for private sector Capex to us is really coming in from two or three big changes that we have seen. The first, of course, is just the policy framework around PLI as well as the tax incentives that the government has given. Now, there have been certain sectors that the government has chosen basis either their ability to export based on Indian competitiveness or import substituting sectors. And these mostly are forward-looking sectors of the future, which the government has identified in terms of giving capital subsidies to ensure that that manufacturing activity happens in the country, leading to both import substitution as well as opportunity for exports. And why does India stand a chance in terms of increasing manufacturing intensity? I think the answer is in the charts below. If you look at the share in global merchandise exports, clearly India has massively underperformed China over the last 2 to 3 decades. If you look at China, which is at 14% of global exports, India at 1.5%. I just like to highlight how telling really the opportunity is. A 10% shift out of China implies almost a doubling for India. So that really is the scale of opportunity. And that really is what we have in front of us. Of course, I'm not even implying that that happens in the near term. All I'm trying to indicate is the scale of the opportunity that is available. And why are we in a position to improve our manufacturing throughput? I think if you look at the chart in the middle, which compares manufacturing wages across different countries, you will see that India stands extremely competitive versus China. Over the last few years, wage costs in China have been moving up. And while this is only manufacturing wages, even adjusted for productivity, India now is extremely competitive. And one of the reasons for that is the chart on the extreme right, which looks at the working age population. Now, labor, of course, is about demand and supply. And while India's working age population will continue to grow over the next 10 to 15 years, China has peaked in terms of their working age population. And actually, the working age population is going to decline. So clearly, they will have supply of labor issues as opposed to India, which still has growing labor force, making us competitive from a manufacturing labor cost perspective. We are already seeing the other catalyst, of course, for manufacturing in India, or the opportunity for manufacturing to shift to India, is just MNCs looking to diversify supply chains. I think the on-off COVID lockdown related situation in China has clearly disrupted supply chains, and given that a lot of supply chains actually were concentrated in China, this has had disruptions, ripple effects across the world. In fact, some of the inflationary pressures are also on account of supply chain disruptions that we have seen. And I think that has triggered global MNCs to sort of diversify global supply chains away from China, which is the China plus one that we are talking about. And while there may be other countries that will also compete for this opportunity, Mexico, Bangladesh, Vietnam, for example, India also will be one of the beneficiaries of this shift out of supply chain from China. If you put that together with the fact that the government is also offering policy benefits for manufacturing in India, it just provides a very favorable landscape for manufacturing intensity to increase. Let me shift back to the potential or the balance sheet capacity of companies to also undertake manufacturing or Capex in India. If you look at the chart at the bottom left, India over the last, in the last decade has actually seen profits as a share of GDP trend down in the last decade, and that has sort of inflected. So you will see that that number is now moving up. which is therefore a good sentiment for corporates to also start Capex. Capex commitment requires positive sentiment from companies, and I think profits inflecting upwards provides that positive sentiment. In addition, if you look at the leverage on balance sheets, the last few years have seen significant deleveraging by corporates, and from a debt equity perspective also, balance sheets are extremely healthy, and therefore a favorable backdrop for private sector Capex to pick up going ahead. Private Capex actually is also at close to decade lows, and in our view, we are going to see a pickup in private sector Capex led by both the manufacturing sector as well as commodity intensive sectors like cement, metals, sugar, and so on and so forth. The balance sheets of companies also support or provide the ability to embark on this kind of Capex. So the point that I'm trying to make is that we will see growth driven by pickup in private sector Capex, which will culminate in greater manufacturing capacity in India. Let me shift now to the next part of the investment activity. So investment activity broadly covers three aspects: corporate Capex that I've talked about, household Capex, and infrastructure. Household Capex, again, is a significant component of total gross capital formation. And after almost a decade of a poor real estate cycle, I think we've now see that change. Affordability is now at extremely attractive levels. So the equivalent of price earnings ratio really for stocks, if you were to do that same exercise for real estate, where prices have perhaps remained flat or just mild upticks over the last 10 years, whereas incomes have more than doubled, and therefore you would see that the affordability for real estate today is a lot better than it has been in the last 15 to 20 years. At the same time, we've also seen that because the launch activity had come off because of government initiatives like RERA, which led to a consolidation of developers, because of the NBFC related issues, which cut out a lot of developers from funding. You will see that launch activity had also sort of come off as the sector was readjusting to several of these reforms in the real estate space, and therefore today inventory issue is not such a big concern. And as we start to see the launch activity pick up, that will also be a contributor to investment growth as well as to GDP growth. Mortgage rates stay attractive, while of course they are trending up. Nevertheless, relative to the affordability that we've seen in the sector, higher mortgage rates are not yet a risk to affordability or the ability to buy new property. This is a chart that I just want to highlight, not from the perspective of talking about valuations of startups, but really to indicate that the entrepreneurial landscape in India is really abuzz. And this is helpful for a capital constrained country like India in several ways. One is, of course, the amount of FDI that the space has been attracting. So if you look at the chart in the middle, this indicates the kind of investments that we have seen in startups in India, and a capital constrained country like India, of course, it's a positive. But the other more important fact is just the kind of productivity benefits that one gets on account of greater penetration of digital ways of working. For example, I think a large part of just dealing with the COVID-related lockdowns has been enabled because of the kind of digital ecosystem that was created in the country. And I think really the impact from a more broader macroeconomic perspective is just the sort of efficient and newer ways of doing business that many of these startups have sort of ideated. And I think that really is something to take away from a more medium-term perspective. Having talked about the positives, let's also spend a couple of minutes talking about what are the risks. Clearly, I think elevated commodity prices are a risk for the economy. India, of course, is a net importer of commodities, crude being the largest, and clearly the Russia-Ukraine crisis has had an impact on crude prices. So clearly, I think that is a risk that one should be cognizant of from a India perspective, because we are net importers. The math is simple. We import about 1.5 billion barrels of oil per annum, and therefore a $10 increase in crude impacts net imports by about $15 billion. So that really is a risk that impacts the economy and something that we should be cognizant of. The supply side clearly has been disrupted on account of geopolitical issues. And while we have seen softening from the peak, nevertheless, this is something that one needs to be cognizant of. Also, given the kind of underinvestment that we have seen in some of the fossil fuels over the last few years, the supply constraint is something that we should have, which could pose a risk to both oil prices as well as to current account deficit in India. However, we must also remember that the oil intensity of the economy has come off over the last few years. The economy has grown at a pace faster than that of the rate at which crude oil demand has grown, and therefore the dependence or the crude oil intensity of the economy has clearly come off over the last few years. The other point and the other risk that we must be cognizant of from a more global perspective is just the fact that we are seeing inflationary pressures in most advanced markets, and that is we are no longer in a world where interest rates are at rock bottom levels. Interest rates globally are rising, and this is something to be cognizant of, especially given the fact that in the near term, global markets are correlated, and therefore we need to be aware of the kind of risks that are facing other parts of the world as well, which may have an impact, if not direct, but at least indirect. So the inflationary pressures and higher interest rates that we are seeing globally is also something that one needs to be cognizant of. The one data point that, of course, I think that most of us would have read is that about 15 months ago, almost $18 trillion of bonds were trading at negative yields, and today that number is a low single-digit number, perhaps. So really, that's the kind of increase in interest rates that we have seen, and it's something again to always remember that we are transitioning from a extremely low interest rate, high liquidity world to a higher interest rate, tightening liquidity world, and therefore the context that the market is in today is quite different from the context that existed perhaps 3 or 5 years ago. Let me touch upon valuations. So as you can see, post the correction, the Nifty 50 is now at about average valuations. So the market is trading at about 17 times, which is 17.5 times, which is really in line with the last 10-year average. However, I would again reiterate that this is a time to be extremely bottom up and company specific, focus on company specific valuations, but this is just to simplify the entire premise. This is a chart on mid-cap valuations. Again, we have seen correction in the mid-cap indices as well. But even post the correction, mid-caps on an average are trading slightly higher than their last 10-year average. I think that the table below, which breaks up the PE by index constituents, I think that is interesting, because you will see the kind of dispersion that exists among the stocks, which is the point that I was trying to highlight, that averages actually are just averages. They don't give us the entire picture. And this dispersion will sort of indicate to you the fact that I was mentioning. As you can see, a lot of activity or a lot of stocks are actually centered above or below the average as opposed to the average. Perhaps only a quarter of the stocks are at around average valuations and the rest are above or below. And therefore, the message that one needs to be a lot more stock specific, bottom up focused in terms of valuations. We've also put up a chart in terms of the relative premium or discount of mid caps versus large caps. So mid caps still not or trading at a slight premium versus their average the last 10-year history in terms of relative valuation to larger caps. The same exercise for the small caps. Again, the dispersion is interesting. You will find a lot more stocks above or below the average as opposed to at the average. So the dispersion is really quite wide. Smaller caps, of course, have seen more correction than the mid caps, and they are trading almost in line with the last 10-year average, both from a relative basis as well as on an absolute basis. This is a chart which I thought is it's good to also take a perspective from a sectoral basis and to see how valuations look on a sectoral basis. As you can see, there is again a fair mix of sectors that are trading above 10-year average, a fair mix of sectors that are trading below 10-year average. And therefore, I think time to be extremely disciplined about sector as well as stock selection. I must caution, some of the in terms of interpreting some of the charts here. So if you look at the metal sector, for example, it appears that the sector is trading at a huge discount to average valuations, but we must remember that earnings in the metal sector can be extremely volatile. So it's not out of the realm to expect earnings to swing by 30 to 40% in the metal sector, just given the kind of sensitivity as well as the price changes that we have been seeing globally. Therefore, it's very easy for earnings to be taken up 30 to 40% as it is for earnings to come down by that number. And therefore, just looking at the multiple for metals, for example, will not give us the true picture. The projection of earnings is critically as important as well. So in summary, I think the message, at least from a more macroeconomic perspective, is that from a medium-term perspective, we do see investment-driven growth to also be one of the contributors for overall GDP growth. While we have had a consumption-driven growth for the last few years, and that has largely been because private capex was muted, the housing sector was muted. We are seeing a turn in some of those factors. We think that private capex should pick up. We think that housing will also be a contributor to investment activity as well as overall GDP growth. Therefore, we will have not just consumption-oriented segments contributing to growth, but we should also see investment activity contributing to overall GDP growth. This is also coming at a time when we have seen balance sheet repair of several stressed corporates as well as the banking space. So the cards seem aligned for investment activity to pick up, both from a demand perspective as well as from a funding perspective. Valuations, as I've shown earlier, they are somewhat reasonable, but it's time to be extremely disciplined and stock and sector specific, because the averages, different sectors have had different levels of adjustment in the marketplace, and therefore we do have sectors which are trading above average valuations and sectors that are trading below. So therefore one needs to be careful in terms of the sector selection choice as well. And the risks, of course, are that of elevated commodity prices, a world of higher interest rates and tightening liquidity, as well as geopolitics. Let me now switch to the funds as well. And the reason I spent time on the macroeconomic backdrop was because a lot of the positioning in the funds you will be able to relate to on account of the narrative that I just gave about the economy. Before I get into the overweights and underweights and the fund positioning, let me just give a brief about the Focus 30 fund. So the Focus 30 fund is flexible in the sense that it is a flexi cap. It is a flexi cap fund where we are only limited by the number of stocks, but we don't have any other limitation in terms of the sector focus or the market cap focus that we have. So to that extent, it is it is a flexi cap fund, ability to invest across sectors, across market cap. One of the perceptions, of course, is that just having 30 stocks makes the portfolio overly concentrated, and therefore, the volatility could be higher. However, as I will show you, it is possible to construct a portfolio which is fairly diversified even within 30 stocks. And I will also show you our top 10 stocks, which have a fair representation from both cyclical as well as the more defensive sectors. And of course, the key point I think about our focus fund is that this is a fundamental oriented product. It is research backed, and therefore it really leverages on the strengths of our in-house research team. And hopefully we represent in a risk optimized manner the best stocks from our sort of research portfolios or research coverage. The philosophy is really, I would say, simple. The idea is to focus on good quality companies and to buy them at a reasonable price. So when I say good quality companies, we are talking about companies which have growth drivers from a medium to long term, where the over a cycle adjusted basis, the growth, we are not looking at a 1 quarter or 2 quarter kind of growth. We are looking at a more cycle adjusted kind of growth, as also companies which have a good competitive positioning, as well as strong management with an ability to not just capitalize on the opportunities, but also manage the risks as they may manifest, either from sector dynamics or from a global perspective. I think the important point is to have managements which are able to take their companies through the good and the bad. And really that's the seasoning of management is also something that we pay a lot of attention to. And last but not the least, of course, very important for us to have a good track record on corporate governance, transparency, as well as ESG. The valuation discipline, I think, is where we'd like to distinguish ourselves. I think we do, while our objective is to clearly identify good quality companies and invest in them, but we also are cognizant of the price that we want to pay for them, and therefore the emphasis on valuation to provide a reasonable margin of safety. The valuation discipline, to my mind, is something that will become even more critical in times where liquidity is tighter, when we are in a rising interest rate environment, because clearly capital allocation becomes even more important in times when liquidity is tight. So I think that we are, of course, focused on good quality companies, but we are also very cognizant of maintaining our valuation discipline and paying the right price for the companies. This is the overweight and underweight positioning of the focused fund. As you can see, so while banks are an overweight, they are offset by an underweight on financial services, but in effect, financial services is an overweight. We are overweight on the manufacturing sector. I talked about the opportunities that exist for manufacturing in India, so industrial manufacturing, as well as for infrastructure and Capex oriented activity. So you will find these sectors represented as overweight. So auto, which is a manufacturing oriented sector, industrial manufacturing, construction, these are the overweight sectors. mostly domestic linked or with opportunities for exports. Several of the global facing sectors are actually underweights. You will see metals, which is a global facing sector. You will see energy, oil and gas, which is a global sector. These are underweights, largely on account of the kind of growth risks that we see in many parts of the world. Consumer is an underweight largely for valuation reasons. Let me switch to the top 10. The key point I wanted to show here was clearly how you will see a good representation of sectors across the top 10. So you will find banking, you will find cyclical sectors like banking, manufacturing, auto, but you will also find defensive sectors like utilities, like pharma. So I think from that perspective, we've tried to ensure diversification across sectors, as well as across both the cyclical as well as the more defensive parts of the economy. As you can see, portfolio beta around 1, so it's not that we are taking too much above market risk in the portfolio. This is a 1,500 crore AUM product. And at this point in time, and I had also shown the charts on valuation for both mid caps, small caps, as well as their positioning relative to, or valuation relative to larger caps. At this point in time, larger caps, of course, on a risk reward basis, appear to be offering a better sort of proposition, and therefore you will see that large caps are a bigger proportion of the portfolio. To my mind, given the kind of volatility that we will possibly see over the next few months on account of global growth concerns, higher rates, liquidity tightening, perhaps the larger caps will probably be able to weather that volatility a little bit better, and therefore you will see the tilt of the portfolio towards the larger cap names. This is the portfolio of the TaxSaver. Again, in terms of positioning, you will find pretty much similar positioning with the focus product. You will find overweights on the financial services, the manufacturing sectors, telecom, as well as underweights on the global facing sectors like metals, energy, as well as consumer being an underweight on account of valuation reasons. Again, here, there is a bias in the portfolio towards the larger cap market, towards larger market cap companies. With that, let me stop.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.